Welcome back, traders. Today we're diving into a powerful trading strategy using MACD divergences and the RSI indicator. These two indicators can provide valuable insights into market trends and potential entry and exit points for trades. By the end of this video, you'll have a solid understanding of how to effectively incorporate MACD divergences and the RSI indicator into your trading strategy. The MACD Moving Average Convergence Divergence is a commonly used technical analysis indicator in stock, Forex, and other financial markets. It consists of three main elements: the MACD line, the signal line, and the histogram. But how does it work? Let's understand its components. MACD line. This line is calculated by subtracting the longer exponential moving average from the shorter exponential moving average. Signal line. It's a 9-period exponential moving average of the MACD line. Histogram. It's the difference between the MACD line and the signal line. The histogram shows the divergence between the two lines and can help identify changes in trend. Now, how to use MACD divergences. A bullish divergence occurs when the price of an asset forms lower lows while the MACD forms higher lows. This suggests that the bearish trend may be losing momentum and a bullish reversal may be underway. It's a potential buy signal. A bearish divergence occurs when the price of the asset forms higher highs, while the MACD forms lower highs. This indicates that the bullish trend may be losing strength and a bearish reversal may be imminent. It's a potential sell signal. Before we move on, stay tuned until the end of the video, where I'll show you a special trick to spot divergences in the MACD indicator. And don't forget to subscribe to the channel, hit the like button, and turn on notifications so you never miss out on our latest tips and tricks. Now let's talk about the Relative Strength Index, RSI. It is a momentum oscillator that measures the speed and change of price movements. It's a popular technical indicator used by traders to identify overbought or oversold conditions in a market. The RSI oscillates between 0 and 100. Traditionally, an RSI above 70 is considered overbought, suggesting that the asset may be due for a reversal or correction to the downside. Conversely, an RSI below 30 is considered oversold, indicating that the asset may be due for a reversal or correction to the upside. A less conventional way to use the RSI is as a trend indicator. When the RSI is above 50, it suggests an uptrend, while when it's below 50, it indicates a downtrend. So this is how we're going to use the RSI, namely, as a confirmation of the trend. Alright, traders. Now that we've got a handle on how both indicators work, let's dive into how to blend them together to craft a killer trading strategy. Let's first explore the setup for a bullish trade. We got to look for divergences between price and MACD to identify potential trend reversal points. Remember, a bullish divergence occurs when price forms lower lows while MACD histogram forms higher lows, suggesting a possible bullish reversal. Once we've identified the divergence, let's take a look at the RSI to confirm the trade. For a bullish trade, we should wait for the RSI to close above the 50 level. So let's place our buy order at the close of the candle. We can set the stop loss below the previous low to allow room for price movement. Finally, the take profit can be placed at 2 times the risk assumed. Well, now let's see how it runs. Now, let's take a look at the setup for a sell trade. First, we'll look for a bearish divergence between the price and the MACD. A bearish divergence occurs when price forms higher highs while MACD forms lower highs, indicating a potential bearish reversal. Once we have the divergence in the MACD, let's confirm the trade by looking at the RSI. It should show a value below 50. If not, we need to be patient and wait for it to cross that key level. Once all the rules have been followed, we can place our sell order at the close of the candle and set the stop loss above the previous high. We will set the take profit order at 2 times the risk taken.
Well, now let's see how it runs. Well, we are reaching the end of the video, and as promised, here is an indicator that will help you to spot the divergences in the MACD histogram. Then go to TradingView and click on Indicators. Type Divergence and select Divergence for Many Indicator version 3. Now, go to the indicator settings and change the values of left and right bars to 10. As you can see, this indicator can show us divergences in many indicators. But for our purpose, we will only check the MACD histogram option. We can also include the MACD indicator to compare both indicators and familiarize ourselves with the concept of divergences between price and indicators.
Remember to backtest this strategy thoroughly and adapt it to suit your trading style and risk tolerance. And as always, stay disciplined and trade with caution. Happy trading! Finally, if you find this video helpful, don't forget to like, subscribe, and hit the notification bell. See you in the next video.